So yeah, there are 40 to 50 million households in Pakistan. That's a great data point. But not all of them are what you'd call middle class. Not all of them are reachable. Not all of them are accessible. Not all of them are interested in buying a life insurance policy. And what's our number in metric for that? That's 10 to 15 million. How much of that is controlled by the current industry? About 5 million. Is there room for growth? Yes. But will that growth lead to 10x growth? No. So how do we grow that? We grow that. We say, okay, this is a limitation. This is a constraint. This is a boundary. This is a box or a wall that we can't scale. So what can we scale? We can increase the number of policies per household. So I know Farah said, or somebody else said, pricing. Pricing is one possible path, but pricing by itself will not let you to or get you to 10x. Value will, right? You have to increase value. So once you identify what the driver is, in this specific case, that driver is lifetime value. Once you specify what that driver is, then you can say, okay, now what path, what trajectory do I need to use to get to that value? And I'm saying to go from $300 to $3,000, to go from 300 million to $3 billion, you have to increase lifetime value. How do you increase that lifetime value? You increase that by selling more policies to every household. That's the path. And remember, we're still not building the model. We're not at the model stage. We're still just doing the groundwork that will help us build that model. Achha, these stories are also important because rather than opening the model and walking an investor through 300 different cells on 600 different tabs, it's important to first set the context. This is what we are trying to do. And our path to doing this follows this specific trajectory or this specific model. This is a vector of attack. So I've sort of explained the high level thinking. Now let's take a slightly deeper dive into the 4 themes that are important that sort of walk into this question. What determines lifetime value for a customer, right? The first is purchase frequency. How many times does the customer purchase your product? Does he purchase it once a year? Does he purchase it 3 times a year? Does he purchase 5 times a year? Does he purchase it every month? So what's the purchase frequency? This is number 1. Second is, do your customers come back? Do you retain them or do you lose them? So do you sell to them once and that's the end of the relationship, or do they come back? Do they keep on coming back? This is a really important question, and I'm going to talk about this a little later. The third piece is contribution margin. So contribution margin is, I've sold a product for, let's say, 1,000 rupees. And of that 1,000 rupees, about 250 rupees is so I sell it on a retail or I sell it through a channel, is my channel commission. So this sort of goes out on the sales side. And then about 600 rupees is my cost. So that's about 850. And about 150 is my profit, right? So contribution margin is the margin that I have available to cover my fixed cost. And then the third piece is, how long does this customer stay with you? Does this customer stay with you for a month, for a year, for 10 years, for 15 years, for 20 years? You can't answer this question if you haven't really understood who your customer is and what drives purchase behavior on his part. Now, these are all important questions, but you have to remember, what are we trying to do? We're trying to build a deeper understanding of our model so that when we present it to investors, when we present it to venture funds, we have a cohesive story, a structured story, which is easy for them to follow. They'll ultimately get down to the model, but much before they get down to the model, they like to understand what is it that you're trying to do and what is your path to doing that. So the first step is lifetime value of customer, right? This is the first thing. 4 parameters: purchase frequency, retention, contribution margin, and customer shelf life. Why are these components important? Speak about how do we grow this segment 10x. If you go back to the insurance industry example, what was the path? The path was sell more policies, X policies per customer. What does that mean? That basically means that you will be able to retain those customers, that you'll be able to convert those customers into repeat customers. And if you could do that, then you'll actually have an organic engine, because in the first year I'll have say about 1,000 customers, and let's say I have an 80% retention rate. So next year I'll have another 1,000 customers, and I'll have 800 old customers. And then the year after that I'll have another 1,000 customers. I'll have 800 customers from the previous year, and I'll have 640 customers from the first year. And the year after that I'll have 1,000 customers, 800 customers here, 640 customers here, and 8 into 6, maybe about 480 customers here. So what is happening now? I'm not just selling to a customer once. If I can retain those customers for 4 years, this base of previous returning customers is adding to my growth path. A segment can grow 10x, but what is your path to growth within that segment? Your path to growth within that segment is retention. So how do you retain customers? What's there in your product that makes them come back again and again and again? So that's number one. Your second question is monetization. How does this product or service offer a tangible outcome in customers' lives? How does it change their life? What is the driver? What's their motivation? What's their thinking when they buy the product? Is this something that they can live without, or is it something which is as essential to them as breathing? So you have to answer this question. The third piece is, how do you convert them? So you've identified the right segment, you figured out how to monetize it, but how do you reach them and convert them? What are the incentives that you offer? How do you sort of get the product in front of them? Where do they purchase it? Where do they buy it from? How do you deliver it to them? How do they find it? These three are essentially linked to this theme. LTV of a customer basically means what? Lifetime value of a customer, but how do you select the customer? So the segment selection piece, the segment selection decision is one of the most important decisions you can make. And as an investor, as a fund manager, I would really want to understand why this specific segment. What are the attributes of this segment? The three attributes that I'm specifically interested in: A, does this segment has a natural growth path to growing 10x over the next 10 years? B, do you understand how to monetize it? 3, or C, how would you convert it? Monetization and conversion are linked to the second theme, and that theme is product. You've already identified one, pricing is a key part, but a second part is stickiness and usage. Does your product have features? Does your product looks at needs and wants that require customers to satisfy those urges or needs and wants on a regular basis? For that specific reason, they'll come back to you again and again. A third is profitability. A fourth is what I call the virality loop. Every customer that you have in your pool or path, does that customer has a path for him or her to refer more customers to you? Is the product experience so good and so great that each customer actually becomes an evangelist for you? Their service quality, their user experience, their flavor of the product is so strong that they want the world to try it. So does your product have this or not? And if it does, then you need to figure out how to sort of bring that not just into your model, but also into your conversation. Your third theme is growth. Now, we've already spoken about the fact that 10x growth is important, but how do you get to 10x growth? You get to 10x growth by starting with a simple use case for n equals to 1. Walk me through the path of how a transaction would work for one single customer. This essentially is the atomic level breakdown of your financial model. Your financial model starts here. How do I make money for one customer? That's your first transaction. If you've gotten this right, then it's easy for you to walk it through. But if you haven't figured it out, then it's very difficult. Then you'll be able to speak to the model in general. But when I say, okay, how do you make money on a single transaction? You would not have an answer to that question. Breaking a transaction down at a single customer level and showing people how you go from one step to the next, how you start from the sale and how does that sale translate into actual margin in the bottom line for you, that's really key. A third piece is competition. Who else is there in the market? A fourth piece is your go-to market. A fifth piece is your capability and potential. If I'm thinking of selling life insurance policies, how do I find people who are interested in buying life insurance policies? Who buys life insurance policies? If I'm interested in selling test prep for medical professionals, exam prep for medical professionals, continuing professional education for medical professionals, where do I find them? What's the incentive? What's the motivator? What do they look for? Who else is there in that space? And how does my product benchmark against them? All three themes, LTV, product, and growth, are linked to each other. They're sort of interlocking pieces. They're sort of a Lego model that you've built that comes together. Then the fourth and final theme is valuation. What is your business worth? One part of this is the financial model that you've built. That shows, $1 of revenue leads to, let's say, 5 cents of net profit. But how much is this worth? That is a function of the interest rate environment. It's also a function of your growth outlook. How fast, how quickly will you continue to grow, and how long will that growth spurt last? It's also a function of how the competitive environment looks like, both in terms of competition as well as your ability to resist and fight that competition. And then how desirable is that business? So one of the reasons why, you're only valuing $1.2 billion of life insurance premium at 300 million is because the desirability index of the life insurance industry in Pakistan is very, very low. Not just at a customer level, but also at an investor level. And multiples, valuation multiples, those what you spoke about, book value, PE, price to earning, premiums, and what else was there? We had sales multiples. These multiples are all a function of how desirable that specific space is at a given point in time for investors. If investors value it, if investors want it, if investors are interested in investing in it, multiples will be higher. If investors are not interested, multiples will be lower. Of the four themes, valuation, growth, product, and LTV, 3 you control. Valuations you don't control. Valuations you don't control because valuation is driven by a lot of factors. One of the most important factors is the external environment. You can't control the external. But LTV, you control. How? Based on your segment selection. Product choices you control. Why? Because they have a direct impact on LTV. Growth potential you control. How? Because again of your segment selection. These 3 factors, 1, 2, 3, are your choices. They're important choices because they ultimately determine how much your business is worth, but they're still your choices. And I think what I've found, what I've learned over the years is that a lot of times when it comes to making these 3 choices, we do a really bad job. And then once we've done a bad job here, it really doesn't matter what the external environment is like. Your business is not going to be worth a lot simply because you made a bad choice. What we're really saying is that you want to increase customer valuation. You do that by selling something of higher value. You do that by making sure that the purchase frequency is longer. You do that by making sure that the customer stays with you longer. You do that by making sure that all of these factors come through and increase your lifetime value. And once you figure that piece out, then the next important piece is to figure out a path to making sure that your obtainable market share for these group of selected customers is as high as possible. If on the other hand, you start from building a financial model, you just build that and you haven't done your groundwork here, then your financial model will not have a life. It will not have a story. It would be almost incomprehensible to investors because they would not understand how to dissect it, how to decode it. To decode this, you need this part. And coming from this specific path also changes your mindset because your model then is built specifically around a segment that you understand, that you want to explore, that you've spent a lot of time on, and given that context and background, it's a lot more easier for you to build a credible story around that.